For the last 40 years, the classic stock and bond split was the gold standard for retirement. You made some money in equities, put a chunk into bonds, and enjoyed a safe fixed income. But today, that foundation is cracking. We are looking at a $345 trillion problem. The traditional fixed income market that over 100 million people depend on is actively draining retiree wealth. With soaring inflation and central bank policies working against you, holding debt is now a guaranteed loss. Over the next 5 minutes, I'm going to show you exactly why legacy bonds and hidden private funds are eating your savings. Then I'll walk you step by step through a brand new high-yield alternative known as digital credit. You don't need complicated offshore accounts or crypto wallets to fix this. Escaping the failing debt system takes about 5 minutes, and you can do it right inside the retail brokerage account you already use. Step 1 is to audit your current retirement statements. Look closely at your holdings to see if your money is parked in opaque private credit funds or U.S. Treasuries. If it is, you are holding an asset with collapsing demand. Right now, foreign governments are actively dumping their treasury holdings, and retiring baby boomers are selling off massive amounts of bonds to fund their daily expenses. To deal with the massive national debt, institutions like the International Monetary Fund rely on a specific strategy that destroys saver wealth. It is an official policy called financial repression. The government deliberately holds interest rates artificially low, letting the red inflation line run hot right over it. Even if a bond pays 5%, inflation runs higher. That gap is a hidden tax, slowly draining your purchasing power. This 5-year Sharpe ratio chart measures asset volatility. When comparing U.S. Treasuries to supposedly risky assets like gold and Bitcoin, the results are inverted. Look at the Treasuries bar stretching into the negative. This risk-free asset actually exhibits higher volatility than digital assets or precious metals. Holding traditional government bonds guarantees a mathematical loss of your purchasing power, all while exposing your capital to some of the highest volatility in the market. Step 2 is changing what you buy. You need to shift your investment criteria away from debt-backed promises and move toward asset-backed income. Comparing a traditional bond and digital credit, legacy bonds are built on hope. You long money and pray they generate cash flows to pay you back 30 years from now. Digital credit is issued by companies holding tangible digital property in reserve today. Because these companies hold decades of capital already in reserve, they can pay double-digit yields, sometimes up to 11.5%, without relying on future operational miracles or marketing campaigns. Major institutional players and architects like Michael Saylor have already validated this model, proving that integrating digital capital directly into corporate finance creates immense stability. Digital credit strips away the hollow promises of fiat debt. It gives you a transparent, mathematically secure asset that functions as a highly reliable cash equivalent for your portfolio. For step 3, you are going to execute the trade. Start by logging into your existing retail brokerage account. Because these yield products are structured and issued by public companies, you skip the headache of managing complex crypto wallets or navigating unregulated offshore exchanges. This immediate public access is vital. Pension funds and retirees are currently pouring trillions into opaque private credit funds trying to find yield, only to realize their capital is completely illiquid and locked up for years. Step 4 is to locate the asset. Use your brokerage search bar to look up a specific digital credit ticker symbol, like typing in STRC. Once you select it, verify the listed yield percentage. Remember, you do not buy this hoping the share price shoots to the moon. It is designed to hold its peg like a money market account and generate steady monthly cash flow. Finally, you enter your amount and click the buy button. Because this trades just like a stock, it has daily liquidity. You can buy in today to secure your yield and sell tomorrow if an emergency requires cash. By completing this step, you have successfully bypassed the traps of locked-up private funds and secured a publicly traded high-yield generator. You've done it. You have effectively migrated your capital away from a failing, debt-based fiat system and into a modernized income stream. Your wealth is no longer trapped in opaque pension plans, and you're no longer losing purchasing power to the hidden taxes of financial repression. Going forward, your only job is to monitor your new monthly payouts as they hit your standard brokerage dashboard. I highly recommend consulting a tax advisor to understand exactly how these yields are categorized for your specific situation. That will ensure your new, high-yield retirement is completely optimized and protected.